And we're back, continuing with our chapter 17 lecture on the purpose of accounting and financial information in business. So, as I mentioned before, companies prepare what's known as financial statements. These are reports prepared on a periodic basis that will tell us certain information about that business organization. Some of those key statements are the balance sheet, the income statement, and what's called the statement of cash flows. And we'll take a look at all three of those statements shortly. Now, in accounting, we have what's called the fundamental accounting equation, which is the basis for balance sheet. The balance sheet is a financial statement that has to always be in balance. On the balance sheet, you're going to have three categories. You have your assets section, your liabilities, and you have your owner's equity. So do me a favor, look up these different terms, assets, liabilities, owner's equity, and send me an email to tell me what each of these categories represent on the statement known as the balance sheet. But again, the term name is balance sheet. So on the balance sheet, your assets have to equal your liabilities plus your owner's equity. Okay? So the balance sheet is a report that shows a firm's conditions as a specific time. So for example, typically this statement is prepared at the end of your accounting period. So let's say on December the 31st, it'll show the total of all of our assets. It will show what type of assets do we have and how much of each asset. It shows the total of our liabilities and the same for your owner's equity. And again, the balance sheet, your assets have to equal the total of your liabilities plus your owner's equity section, also known as stockholders' equity. So if you remember, we talked about different type of business structures. If you have a proprietorship or partnership, we call that owner's equity. But if you have a corporation, then that would be known as stockholders' equity. Okay? Assets that are relatively permanent, such as buildings, are known as A, B, or C. If you say C, fixed assets, that will be correct. Okay? So I know I asked this question and said to send me an email about it, but I'm going to get the answer to the question right here. So let's talk about assets. What are assets? Assets are economic resources, things of value that are owned, I want to say, or controlled by a firm. Items can be tangible or intangible. So let me help you out with that. We're talking about the resources owned by a firm as being assets. That can include things such as cash, their equipment, their property, land, building automobiles, are examples of different types of assets. Liquidity focuses on how quickly or easy can an asset be converted into cash. So on the actual balance sheet, we list our assets in order of liquidity. We first list our current assets. These are items that are one in the form of cash already or can be converted into cash in a relatively short period of time. So, for example, let's say that we are a retailer and we're selling products. That product you're selling is known as inventory. Inventory is a current asset that can be converted into cash typically in a time period of less than 1 year. Then you have what's called your fixed assets or permanent assets, such as land, building, and equipment. And the third category we call intangible assets. When you have these intangible assets, it means that as the owner, you have certain rights and privileges of as being the owner of these intangible assets. But now we're talking about items such as patents, trademarks, copyrights, trade names. So when you think about a company such as Gucci or Rolex, those are trade names for those companies. They have the right to sell those products using that particular trade name. Okay? Now, assets are good. Again, those are things of value that are owned or controlled by a business. But sometimes, in order to acquire assets, you're going to have what's known as liabilities. Liability refer to the debts of a business organization. Perhaps you're saying, what are liabilities? Let me help you out. If you have a car note, you have a liability. Student loan, that's a liability. If you have a mortgage for your house, that's a liability. So those refer to the debts of a business. Some common types of liability are what we call accounts payable. So when companies owe money to other companies because they may have received a product or a service on credit. On credit means that they haven't paid for it just yet. They may pay for it in 30 days, 45 days, etc. But when it says accounts payable, that means a company owes someone else for a product or service that they receive on credit. Notes payable refers to it could be a short-term or long-term liabilities that a business promised to pay by a certain date. So when you have a notes payable, you sign a promissory note. That is a written agreement where you agree to pay back the amount you borrow plus interest at some point in time in the future. Bonds payable. What is that? Well, bonds are a form of debt that can be used to receive cash. So company and government agencies can issue what's known as bonds. Typically, these bonds are long-term liabilities because they'll be paid back, but in a time period of longer than 1 year. Okay? Owner's equity. Owner equity shows the amount of business that belongs to the owner minus any liabilities owed by the business. Owner's equity is sometimes referred to as being a company's net worth. So, if I look at all the assets of the business to determine what is their value, but then subtract out all of the liabilities, which shows what I owe to others, the difference is known as your owner's equity. Okay? Retained earnings is used for corporations. This is showing the accumulated earnings of a business over a period of time that were not paid out in dividends to the stockholders. So we're saying that if a company has made a profit each year for the last 10 years, what portion of that profit have they retained? What portion was not paid to the stockholders in the form of dividends? That balance is known as your retained earnings. Okay? Next up, we have a financial statement that we'll take a look at in a few, known as an income statement. An income statement. This statement shows a firm's profit, or it could be loss, after costs, expenses, and taxes. It summarizes all of the resources that have come into the firm, known as revenue. So, revenue refers to an increase in assets or an increase in money that has been earned either from providing a service or from selling a product, or it could be a combination of those two. On the income statement, we compare the revenue against our expenses. What are expenses? Expenses are the cost of doing business. Expenses must take place in order to earn revenue for the business organization. Expenses could be paying our employees, buying supplies, rent, advertising, insurance, examples of different types of expenses. Now, on the income statement, it will show whether we have net income or a net loss for a specified period of time. Now, if your total revenue exceeds your costs and expenses, you will have what's known as net income, meaning that your company earned a profit. But if your costs and expenses are more than the revenue earned, that means you had a loss for that time period, which is known as a net loss. If a company has a net loss too often, we call that bankruptcy. Yep, because if you keep losing money, then you're not going to be in business very long. Here we have the formula for an income statement. This is a traditional formula. It can vary a little bit from company to company, but you look at the revenue, that shows the actual money earned from providing goods or services, minus the cost of goods sold. So cost of goods sold represents how much the company paid for those products that were sold to their customers during the course of the accounting period. As we discussed before, I'm pretty sure you understand that when you buy a product, that's not how much that company paid for their product. You know that, right? Okay, just making sure. So if you go to the store and you buy a pair of shoes for $200 for the company, that's revenue. That same pair of shoe money only cost them $25 or maybe $50. That's their cost of goods sold. The difference is known as their gross profit or their gross margin. Then you have your operating expenses, cost of doing business. We talk about those again, paying salaries, advertising, rent, insurance, etc. We'll subtract the operating expenses from our gross profit to determine our net income before taxes. Now that's important because your taxes are a percentage of your net income before taxes. Now, currently, corporations have a flat rate of 21%. Their taxes are 21% of their net income before taxes. Subtract the taxes from the net income before taxes to determine whether we had a net income or a net loss for the accounting period. Okay? So, as I mentioned, revenue is a monetary value a firm receives for goods sold, services rendered, or other payment. So I want you to think about your place of employment. How does your employer earn revenue? Send me an email indicating how your employer actually earns revenue. Cost of goods sold. Measure the cost of merchandise sold or the cost of raw materials and supplies used to produce an item for resale. So we're saying that if a retailer, such as a Macy's or a Walmart, if you will, if they buy a product already produced, they have cost of goods sold. But if you're making the actual product, such as a car manufacturer, then we're saying what did it cost you to generate that actual product? So again, revenue minus cost of goods sold equals your gross profit or your gross margin. That is showing how much a firm earned by just making and or selling that actual product. Wow, this is such great information that you need to know if it is your intent to run your own business organization. Stay tuned for our next video lecture covering chapter 17. See you shortly.